It has been 3 years since the Federal Reserve cut interest rates to virtually zero, but a strong economic rebound has been slow to materialize. How has this affected the bond market? We're joined by Michael Materasso, a senior portfolio manager at Franklin Templeton Investments. The firm oversees almost $300 billion of bonds. We've been trying to get you back here for months. Welcome back to Bottom Line.
Phil, thank you very much and glad to be here.
Sum up 2011 for us. Are the markets already factoring in perhaps dire economic and political outcomes?
Well, I think in summing up 2011, it's really been a year of systemic risk. And I think the U.S. is a good example of that. This year, the U.S. economy has grown, has expanded each quarter. Not at a terrific pace, but we started at a 0.4% in the first quarter, and currently now, even with the revision downward, 1.8%. Interest rates have gone the opposite way. We started the year at about 3.25%. Right now, we're a little bit below 2%. Why is that the case? Because of these big macro factors that have gone on in the U.S. initially, in August with the downgrade of the U.S. credit, and then and at the same time the problems in Europe and the systemic risk.
That credit downgrade, did it have the effect that a lot of people thought it was going to be? Because at first it seemed like it was a body blow, and a lot of people were upset because then all of a sudden you say, well, you know what, we're the United States of America, and when we say we're going to pay our bills, we're going to pay our bills. A lot of people said the downgrade was unnecessary. Has it had any effect at all?
Well, typically with downgrades, your cost to borrow money goes up.
Yes.
And even before the Fed hinted at Operation Twist, even before the Fed started talking about a zero interest rate policy for 2 years, rates were already declining. So it seems as though it didn't have an impact. Initially, the markets, the equity markets acted very negatively to the downgrade. Interest rates declined on treasuries, but interest rates continued to stay low on treasuries even as the equity markets recovered.
How's Operation Twist been? Has it been successful?
I think it's been slightly successful. Before the announcement, the difference in yield between a 10 and 30-year bond was probably about 1.25%. Now it's about 1%. The yield curve is flattened, but I would say from 2s to 10s, but I would say that's more about lower interest rates rather than the flattening of the curve because of Twist.
Today we saw Treasuries pairing gains that stronger than forecast jobless claims, consumer confidence, leading indicators. Is there an appetite, at least right now, for higher yielding assets?
It seems as though, despite the good news, and I think that's really the good story for the U.S. in terms of trying to take on these risks here in the U.S. as well as in Europe, is that the U.S. economy seems to be gaining some momentum, not at a terrific pace, but still gaining momentum and operating on more cylinders, and that's important.
But there are still headwinds, but we seem to be navigating those better than we did earlier this year.
We sure do.
Are you surprised by that?
I am surprised. I'm not surprised in terms of the strength that we're seeing right now, the relative strength, because we expected a cyclical rebound in the second half of this year. What I'm surprised about is how low the bid that you see for treasuries.
Yes.
You get some good news out of Europe in the morning or overnight. You see treasury yields rise, but by the end of the day, they're back to unchanged or slightly lower yield. So this continues to be a bid for treasuries. And when you look at the spreads on investment-grade corporate bonds and on high yields, where they are today as compared to at the end of the month, last month, they're tighter, but they're wider than they were a couple of weeks ago.
What needs to happen before we see a reduction in risk premiums?
I think we need more certainty in terms of how Europe is going to play out.
Is that the big, I guess, the elephant in the room now, Europe?
I think so, especially when you look at investment-grade corporate credit here in the United States. The fundamentals from a bond investor are very strong. Tremendous liquidity, terming out of debt, and yet spreads are wider today on U.S. investment-grade corporate bonds as compared to 6 months ago.
Let's go back to the Fed for just a second. Two things. Is the specter of inflation lessened now, and is QE3 off the table?
Is the specter of inflation less now? Well, I think that inflation, I'll answer the question by saying I don't think that inflation is a problem to the extent that global factors cause inflation to rise, in other words, higher oil prices. That has a tendency to take away from disposable income from consumers, and it slows the economy down. So I really don't think that's a problem. Having said that, core CPI has risen 13 months in a row from 0.5% back in, I think, September or October of last year.
My colleague Tom Kane mentioned
to 2.2%, I think, for the most recent print. That's surprising. That is surprising, but the bond market doesn't seem to care.
Michael Materasso of Franklin Templeton Investments. We're going to ask you to hold over. We are going to get to Europe when we come back from the commercial break. Stay with us. Bottom Line on Bloomberg Television continues in just a moment. Welcome back to Bottom Line on Bloomberg Television. We are back with Michael Materasso, a senior portfolio manager at Franklin Templeton Investments. The firm oversees almost $300 billion of bonds. Our discussion now about Europe, the sovereign debt crisis over there. The threat of a recession and deflation are hanging over Europe. I was just speaking to Michelle Meyer of Bank of America Merrill Lynch before you came on. It appears that Europe might already be in a recession, maybe not in the macro sense, but psychologically people seem to be in that frame of mind. What would a recession or deflation there mean for already depressed U.S. Treasury yields here?
I think that if Europe goes into a recession and it's a mild one, the impact would be very little. The portion of growth, GDP growth for the United States coming from Europe is very small. I think just about 2%. So even if there was a major contraction in our exports to Europe, the impact on our economy would be pretty small, and we're not anticipating that.
What does that say about the strength of this economy and what appears to be momentum building, albeit slowly?
Yes, and I think I would agree with that. When you look at jobless claims, they've been trending down since September, even before the holiday season began. When you look at the household survey of employment, last 4 months averaging over 300,000 jobs per month, and the household survey captures a lot of small businesses. I think that's extremely important. New car sales, 13.5 million. So these are things that are, far from where we want them to be, but they are heading in the right direction. And I think that these are very important factors, and extremely important as compared to a year ago when we were concerned about an elevated level of jobless claims and things that were not in such good shape.
Are treasuries overpriced?
I think in the intermediate term they are. I don't think that treasuries are going back, say 10-year treasuries are going back to 5% anytime soon.
Yeah.
But keep in mind, in July, when we were concerned about a double dip, the 10-year treasury was above 3%. We didn't have a double dip. The economy grew in the third quarter, and yet interest rates are lower by about 1%. So we could be closer to 3% and still be in a low interest rate environment. Investors
seem to be comfortable staying with U.S. Treasuries. Is that going to continue as long as this debt crisis in Europe plays itself out?
I would assume so. I think that this is definitely a safe haven investment for many investors, and it will be, and it's a very large liquid market.
The Dallas Fed President Richard Fisher, he was speaking last week. He said the sovereign debt crisis in Europe and a deceleration in emerging markets may be, in his words, poised to knock us off course. But you think that this economy is building momentum. Does that signal a level of confidence in the markets and in the U.S. economy that we have not seen for the majority of this year?
I think you have to differentiate between how the economy plays out in Europe and the emerging markets and how the markets play out. If we have a significant downturn in equity prices in Europe, if we see Italian yields go beyond their highs, that is going to cause lower Treasury yields here. That probably will have a negative impact on the equity markets, and that because of that, it could have a negative impact on the U.S. economy. I'm not in Mr. Fisher's camp in terms of that, in terms of the optimism, in terms of the U.S. But I think that those are the factors, not so much their economies, but more the market reaction, and as it filters over, passes over to the U.S. equity market and U.S. fixed income markets.
Mr. Materasso, before I let you go, we have a minute left. I have to ask you about the politics in Washington. As somebody who does what you do, is this a frustrating time for you?
It's very frustrating because what concerns me is that we have a lot of wood to cut in terms of getting this country back on course. We need major changes. And I think it's possible that politicians see almost every day the Treasury auctions off, sells debt at ridiculously low levels, never have a failed auction, and they could be saying, you investors, you're overplaying this. It's really not all that bad. And I think we've seen over and over again that confidence can turn on a dime, and we can't be complacent about that.
Michael Materasso, Senior Portfolio Manager, Franklin Templeton Investments, joining me on set. Sir, pleasure to have you back.
Thanks, Mark.
Thank you so
Happy New
much
Year.
for your time. You too. Thank you so much.